Your coworker made the same amount as you last year. Same title. Same salary. Same office. Same parking spot. Same bad coffee from the same machine on the third floor. You owe $4. Do a suit in April. She doesn't. You ask her about it once. Casually. In the way you ask things, you actually need to know, but pretend you're just curious. She says something about her accountant and a structure. You nod like you understand. You don't go home and look it up. You go home and pay the $4. 200. This video is about what she knows that you don't. It's not complicated. It is expensive to not know. 3 people. Same income at every level. Different structure. Different outcome. By the end, you'll understand why the tax code isn't broken. It's working exactly the way it was designed to work. You're just not the one it was designed for. Level 1. $35,000 a year. You are a W-2 employee. Your employer processes the math before you see a dollar. Federal withholding. SCAD the holding. Social Security at 6. 2% of your gross. Medicare at 1. By the time the direct deposit hits your checking account, the number has already been trimmed. You didn't choose the trim amount. You filled out a W-4 when you started and mostly guessed. Your effective federal rate this year sits around 10 to 11%. The standard deduction for 2025 is $15. 200 ohal treads for a single feeler. That's the only tool W-2 gives you at this level. One tool. Standard. No options. Across town. Someone else makes $35. 000 through an LLC. They pay self-employment tax 15% on net profit. Because at this level, the LLC hasn't elected S-Corp yet. And the IRS sees them as both employer and employee simultaneously. Their tax burden is heavier right now, not lighter. The structure costs more at level 1, but the structure is not about level 1. The structure is a decision you make before the money is big. So that when the money gets big, the decision is already made. Your coworker made that decision 3 years before it mattered. You are still deciding. Or more precisely, you decided by not deciding. Which is how most people choose. Rule 1. The W-2 is a tax bracket. The LLC is a door inside the bracket. At 30 się change. Ling ling ling. You cannot yet see what's on the other side of the door. But someone is already holding the handle. Level 2. $75,000. You are in the 22% bracket now. You feel the jump. The paychecks are bigger, but the percentage taken feels higher. And it is. You still get the standard deduction. You still have one tool. You have nothing to itemize because you rent. Or because your mortgage interest isn't enough. Or because nobody explained to you that above-the-line deductions existed and you never asked. Net Federal and FICA. Your effective take-home on $75. 000 is somewhere around $56. 000 before state taxes. You feel like you're doing well. You are. And you are leaving money on the table every single pay period without knowing it. Here's what the LLC owner at $75. 000 does differently this year. They elect S-Corp treatment with the IRS. That is a Form 2553. One filing. It changes everything about how their income is categorized. They pay themselves a reasonable salary of $50. Ling ling ling. The remaining $25. 000 comes out as an S-Corp distribution. Distributions are not wages. The IRS does not apply self-employment tax to distributions. That 3% bite, the one that was hurting at level 1, is now gone on $25. Ling ling ling. The savings $3. Bye-bye Arsha Wu. Not invested yet. just not paid to the government. Already. They also take the qualified business income deduction. For 2000 of femoktuv. Pass-through business owners can deduct up to 20% of qualified business income from their taxable income before the bracket applies. On 25. Zero Poos distribution. That's $5. 0, 0, 0, removed from the tax base. You don't have access to this deduction. It does not exist for W-2 income. It was written for owners. Same gross income. You and the LLC owner. Different math at the bottom of the page. The gap at $75. 0, 0, 0 is not yet dramatic. It is a preview. Rule 2. The bracket is the same number on both returns. The deductions are not. You are measured by your income. The structure is measured by what's left after every legal reduction the code allows. Those are two very different measurements. Level 3. $150,000. This is the level where the gap stops being a preview and starts being a number you can feel. You are a W-2 employee at $150. Ling ling ling. You are in the 24% federal bracket. You are also paying the 0.9% additional Medicare tax on income, over $200. 000, not yet. But you're approaching it. Your employer withholds 2% Social Security on the first $176. 900 of wages and eins. 45%. Medicare with no ceiling. You have no QBI deduction. No business expense deductions. No entity to run income through. There is also a number that does not appear on your W-2. Your employer pays set 65% of your salary in payroll taxes, their share of FICA before you ever see the money. On 150. 0, 0, 0, that is $11. 475 that your employer spends on your compensation. That flows directly to the IRS. And that you will never see or control. Your actual cost to your employer is roughly $161. 475. Your W-2 says $150. Ling ling ling. The difference exists. It just doesn't exist for you. Marcus earns $150. 0, vdva. He is good at his job. He got a raise this year. He has no idea about the $11. 475. He has never been told. His HR department has never mentioned it. His offer letter did not include it. He accepted $150. 000 as his compensation. He was not wrong to do so. He was just not told the full picture. The LLC owner, at $150. 000 has elected S-Corp. Salary set at $80. 000, a defensible, reasonable compensation number for their industry. Remaining $70. 000, taken as distributions. Self-employment tax on distributions 0. Annual savings over Marcus, from this one move, approximately $10. Tsibay. They contribute to a solo 401k. The employee deferral limit in 2025 is $23. Wubay. Plus employer contributions, up to 25% of their W-2 salary. For a combined maximum of $70. 000 this year. Their retirement contribution reduces both their taxable income and their adjusted gross income simultaneously. They deduct their health insurance premiums as a business expense. They write off the home office portion. The equipment. The software subscriptions. The CPA costs $4. 000 a year. The tax savings this year, $38. Ling, ling, ling. That is not a close calculation. And now there is a third person at $150. Ling, ling, ling. You don't know their name. They do not have a salary. They have a trust, a portfolio built and transferred, generating $150. 0 inches long-term capital gains and qualified dividends. In 2025, a single filer, paying long-term capital gains tax at $150. 000 of income pays 15%. Not 24%. 15. No FICA. No self-employment tax. No withholding. The check arrives, or the statement does, and the rate is lower than yours. On the same dollar amount. Because the dollar has a different legal origin. 3 people. 150美元. Ling ling ling. 3 different relationships with the same tax code. Rule 3. The W-2 is the most taxed legal method of receiving income in the United States. It is also the method used by the majority of working Americans. These 2 facts are not a coincidence. One of them made the other easier to sustain. Level 4. $250,000. You have done everything right. V. 2. 250美元. Ling, ling, ling. You are in the 32% bracket. Pushing into 35% on the marginal dollars, above $250. 526 in 2025. You are subject to the 0.9% additional Medicare surtax on income above $200. Ling ling ling. If you have any investment income, the 3.8% net investment income tax may apply. Your itemized deductions, if you have them, have limited phase-out provisions that reduce their value. The standard deduction is still $15. 750, and feels increasingly small. Your total federal tax liability at $250. 000, somewhere between $65. 000 and $72. 000, depending on deductions. Add FICA on the applicable portion. Add state. In California, add another 9.3% on income above $66. 295, with a 1% mental health surcharge on income above $1 million approaching, but not yet applicable. In New York City, combined federal and local effective rates above $250. 000 approach, 50% on the marginal dollar. You net $140. 0.002, $160. 0.000, after taxes. You own a good life. You own less of your income than you think. Same $250. Ling, ling, ling. S-Corp structure. Salary, $100. Ling ling ling. Distributions, cent compte-l'air. Ling ling ling. The math SE tax only on the $100. 000 salary portion. QBI deduction of 20% on $150. 0 inches qualified business income removes $30. 000 from the taxable base before any bracket applies. Solo, $401K, maxed at $70. Ling 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 23 美元. 500 employee deferral plus employer contribution of 25% of W-2 wages, completely removing $70. 000 from taxable income this year. Health insurance deducted through the business. A. Section 179 equipment deduction if the business has purchased qualifying assets. Total tax liability for the LLC S-Corp owner at $250. 000, somewhere around $38. 000 to $45. Ling ling ling. Half of what Marcus pays. Not because they made less. Because they made the same amount in a different container. Marcus found out last year. Not from a CPA, he doesn't have one. He found out at a dinner party. The way most Americans learn anything important about money accidentally. Too late. From someone who mentioned it like it was obvious. He went home and looked it up. The numbers were real. He sat with them for a while. He still files W-2. He keeps meaning to make a call. The trust, at $250. 000, long-term capital gains taxed at 15%, federal, on the applicable income. Some distributions pass through to beneficiaries and taxed at their personal rates, which are lower. The trust's accountant is the same species of professional as Marcus's HR department, but they work for a different master. Rule 4, at $250. 0. V2. You are generating enough income that the difference in structure is worth more than most Americans earn in a year. The gap is no longer theoretical. It has a dollar amount. It compounds. Level 5. $500,000 and beyond. You make $500. Ling ling ling. V2. You are in the 35% bracket on most of it, hitting 37% on dollars above $626. Sembaiwusher. Your RSUs vest and are taxed as ordinary income at your top marginal rate on the vesting date, the value of the shares that morning, whether or not you sell them. Whether or not the price holds. You pay taxes on paper value at real rates. Some years the stock drops after vesting. The tax does not. Federal tax, at $500. 000. W-2 north of $160. Ling ling ling. FICA on the applicable base. State taxes in a high-income state pushing the combined effective rate above 45%. Your net is roughly $260. 000. To do a centatanta dollary. Ling ling ling. You have a high income and a lower percentage of it than almost anyone else in this video. The system does not reward you for earning more in a W-2 container. It extracts more. The LLC to holding company structure at $500. 000 is now plural. Not one entity, multiple. An S-Corp or LLC for active business income. A separate entity for real estate or investments. In some cases, a C-Corp holding company taxed at the flat 21% corporate rate. Distributing profits as qualified dividends, taxed at 15 to 20% at the personal level. The income does not flow from work to person in a straight line. It moves through entities, gets categorized, gets reduced, and arrives at a personal level already shaped by structure. The tax is real. The rate is chosen. The trust at $500. 000 has been building for years, possibly for a generation. This is the level where the step up in basis becomes the most important number in the conversation. When assets inside certain trust structures are transferred at death, the cost basis resets to the current fair market value. A portfolio that was worth $800. 000 when it entered the trust and is worth $5. Ling, ling, ling. 000 today. That $4. Liambei. 0 inches. Appreciation passes to the next generation with no capital gains tax owed. Not deferred. Eliminated. The gain existed. It will never be taxed. This is not a gray area. It is written into the Internal Revenue Code. It has been there for decades. Every Congress that has discussed removing it has, so far, not removed it. You make $500. 000 from your labor. You are taxed accordingly. Someone else built a structure a decade ago, transferred assets into it, and their children will inherit $5. Ling, ling, ling. 0 inches, unrealized gains, they will never pay taxes on. You and that person both live in the same country, file with the same IRS, and operate under the same tax code. The code treats you differently. Legally. By design. Rule 5. The wealthy do not avoid taxes. They operate inside a different section of the tax code than you do. Those sections were written by people with accountants. They were lobbied for by people with trusts. They have survived because the people who benefit from them also fund the campaigns of the people who write the laws. This is not conspiracy. This is public record. Your coworker is still at the same company. Same title. She made the same salary as you again this year. She does not owe anything in April. She actually received money back, not a refund exactly, but a distribution her entity overpaid in estimated taxes and is now returning to her. It arrives in her business account in March. She reinvests it before you file. You paid $4. $200 again. You'll pay it next year too. Unless something changes, the something that changes is not your income. It is not your discipline. It is not your ambition or your work ethic. You have all of those. It is a phone call to a CPA who understands entity structure. It is a decision to treat your income as something you can organize, not just something that happens to you. It is the recognition that the tax code is not a fixed wall. It is a building with many rooms. And W-2 employees are standing in the most expensive one. You don't have to stay there. Somewhere tonight. Someone is on the phone with an accountant they found 6 months ago. They are learning that their gross income and their taxable income are two different numbers, and that the distance between them is a choice. It is paperwork. It is a few $100s a month in professional fees. It is also at o sutachinzich 000 of income, worth $30. 000 to $40. 000 every year compounded. Reinvested. Left alone to grow. The number on the W-2 was never the story. The entity was always the story. You just needed someone to tell you which room you were standing in. Comment structure below if this changed how you see your tax return. And watch this next, because the conversation your accountant isn't having with you is the one that costs you the most.